Do you understand the basics of how buy-to-let tax works in the United Kingdom? Do you understand the different structures in which you can hold buy-to-let properties? Do you even understand the difference between how tax on your own personal life works versus your property portfolio? If you don't know the answer to that, then hang with me for the next 4 minutes and 43 seconds and I will answer that for you. My name is Dr. Rowe. I've been teaching property for many, many years, and this is one of the subjects that comes up a lot. So I've got my iPad in front of me. Hopefully it's going to open up and I can do this with you. So first things first. How it works in this country essentially is that you can have, let's just do this, you can have property held in primarily 3 different vehicles. One in your own name. This is where you operate as a sole trader. Okay. The other one is if you have it in a partnership. All right. So partnership. Excuse the scribble. And the last one here is if you have it in a limited company. Now there is limited liability partnerships as well, but I'll keep it simple for now. Okay, if it's in your own name, there are certain tax implications here. For example, there's something called Section 24 or Clause 24, and that works on the principle that the mortgage interest rate, the payment that you pay on your mortgages is not tax deductible. It can't be offset against the business, all right? Whereas in a limited company, it can be, all right? So the mortgage interest can be offset because it's in a different structure. In a partnership, it cannot be offset. In a sole trader, it cannot be offset. So these are your 3 primary structures, and you might be holding property already in your own name and you're thinking, oh my gosh, I've got a large mortgage. Maybe the interest is, for the sake of argument, £800 a month, which is about nearly £9,000 a year or thereabouts. And that is not tax deductible. It would be if it's in a limited company. So these are things to consider. Now, I can't give you advice, can't give you tax advice. I'm not a tax advisor. I'm just giving you information here to be aware of. So that's one thing to be aware of. Also, another thing to be aware of when it comes to this, and I'll see if I can just go to another page, just one second, is, we'll go back a page here, that when you have properties in your own name, as a sole trader, then there are certain expenses that you can claim, right? So you are allowed to claim certain expenses against each property. So when you own a property, all those expenses can be claimed against that. And there are specific expenses that are allowed as a property investor. You can't just randomly, let's say you had a sole trader business over here, and that sole trader business offered consulting and other things that are non-property related. As a general rule of thumb, you can't really sort of offset these costs into there. They're 2 separate businesses. And that's the other thing I wanted to get across to you, is that how it works in property in the United Kingdom is anytime you own properties in your own name, or in a limited company for that matter, the income and the costs are all considered to be independent of anything else that you do. So that leads me to this, which is basically if you have a property buy-to-let portfolio over there, sorry about the scroll, and you have your own income here, you might have a job, could be one, you might have a sole trader business, you might have a consultancy business, etc. These are only the costs and the income for that business. You cannot do a crossover as a rule of thumb. Again, seek advice, get guidance from an accountant on this. That's not what I am here. I'm just giving you an overview here. So some people think, oh, well, I've got a loss here. I can kind of offset that against the profit that I'm making over here in my job, or maybe in my sole trader business. You generally are not allowed to do that because property is classified as a standalone business. So the more properties you buy over here, that becomes its own income and expenses model, and everything else is separate to that. Now, it's important that you know that and learn how to do this. While I run property courses, can't get that to work. Okay, not to worry. I've got 23 seconds left. What's the main message here? The main message here is that when you're running a property business, remember to think about the entity you put it into, and certainly if you're expanding your portfolio, a lot of people feel that a limited company long term is the most tax efficient way to do it. All right, but again, seek advice on that. It's Dr. Rowe signing out. Follow, subscribe, click on the link, like, put your comments in here. See you on the next post.